Businesses seeking redress after being missold derivatives are starting to get offers through from the banks under the FSA Review's pilot scheme. However, underneath the scandal is the tangled and murky world of administration.
Well, it's absolutely destroyed our family because, of course, I've now been out of work since last June, trying to see if we could come to a deal to refinance the company and rescue the company, and considering with Barclays, which has been unsuccessful despite our attempts. Now I'm in a situation that I'm trying to restart a new business with my colleague, and of course I don't have any earnings coming in at all. I have a mortgage, 2 teenage daughters, and I'm unable to service my mortgage at the moment, so it looks very much like I will now have to sell my family home, move down and use some of the money that's in my family home to try to restart a business.
Well, for me, my life was destroyed. It was destroyed probably on the date we entered into this toxic product.
Is it right that a bank can do this? Is it right that a bank can effectively dismantles someone's life on the basis of a fundamentally flawed decision process? It wouldn't even be so bad if there was actually some method in all this madness, but really there isn't. Not that I can see anyway.
We think it's quite widespread. We haven't got any figures on it yet, but we're estimating there's probably 150 cases in the offing at the minute. But more worrying is if redress isn't processed and moved faster, there could be more cases coming into this criteria or into this zone.
Throughout the scandal, businesses have had to pay thousands of pounds in interest rate swap agreement payments per month. But for businesses like Jon Welsby and Mike Lloyd, the banks have started to use a very little known loophole that they use to retract financing and in a way force them to liquidate. And this is even if they can prove that they can still carry on trading. For many SMEs that do have a property portfolio, within their contract for their loan and their swap agreement, there is a clause saying that the loan to value percentage has to be at a certain level. However, over the years, banks have then forced the businesses to even pay for a valuer to come in to give a new valuation. When interest rates actually went down, a lot of the valuers, which do have a close relationship with the banks, ended up axing valuations by as much as 65%.
In 2008, we were compelled to set the product. In 2009, we were offered an alternative product. We declined. Because we started to understand that these things weren't necessarily to protect us. In 2010, we were offered another alternative product, a European flipper swap. It came to 2011 and the bank changed the terms of their lending to us. They made it impossible to trade forward. The cash flow then was affected by tens of thousands a month. The monthly premium, the very last one we paid, was just under £17,000, and that was coming out on top of the loan interest. So it made it virtually impossible to afford as we went forward because the economy had changed. We realised that the property market had changed. But not only that, the bank started to direct us as to what to do with the cash flow and also to look to sell properties, which only weakened our ability to actually pay this what was becoming a very toxic, expensive product running alongside our loan. Well, it's worse than limbo. The way that it is that in June 2011, 3 years after the bank had sold us this swap product, they had an option to break. They didn't. We asked them to, we illustrated to them that we needed to be able to get anywhere near like the company going forward again. They didn't break the swap. At the same time, they instructed a valuation, and that valuation, when it came to being reported on in August of 2011, showed that we were in breach of our loan covenants because some of the valuations were slashed by up to 2/3 taken off the valuation.
Ian Gibson is an ex-director at Savills and actually conducted Jon's first valuation back in 2008. However, since moving from the company, Savills has actually done a second valuation, which he argues was not only wrong, but also pushed Jon into administration.
When I go through and read the report, there's even less justification for it because the rhetoric and the methodology is simply not within that report. And to be frank, it's littered with errors. And it's a report that had a graduate done for me as a director of that firm, it would have been promptly thrown back in his face. This has been signed off by a senior director ratified by another senior director. It's gone to the bank. There's a 65% reduction. Jon himself has articulated to them, I'm not happy with this. And then no action has been taken with that. To me, this is just common sense. I'm not speaking as a valuer or a banker. It's common sense that if you've got a portfolio valuation that you're happy with, that they've lent against, there's no issues with, and then the same firm come out and revalue it and elicit that sort of a reduction on it, that anybody would have an issue with that, and it should have rang alarm bells. I find it very sinister that the bank have literally steamrolled over Jon. And the main issue for me is that the bank weren't concerned with this at all. And ultimately, in respect of Jon's particular case, it was that valuation that drove him into insolvency.